Mortgage. A mortgage is what happens when you want to buy a house, but you're not a billionaire, which, let's be honest, is most of us. Here's how it works. You find a house you like. Let's say it costs $300,000. You don't have $300,000. So you go to the bank and you say, hey, can I borrow $300,000? And the bank says, sure. But here's the catch. We're going to own your house until you pay us back, and we're going to charge you interest on top of that $300,000. So now you're not just paying back $300,000. You're paying back $300,000 plus interest. On a 30-year mortgage at 7% interest, you're actually paying back almost $600,000. That's double. The bank basically gets to charge you an extra $300,000 just for letting you borrow their money. And the crazy part, this is considered a good deal. This is the loan people actually want. Why? Because the alternative is renting, and renting is throwing money away. At least with a mortgage, after 30 years, you own something. With rent, after 30 years, you own nothing. So people take the mortgage, they sign their life away for 30 years. And honestly, it's probably the best financial decision most people will make. But it's still a trap. It's just a trap that makes sense. The bank gets to hold your house as collateral. That means if you don't pay them back, they get to take your house and sell it. So the bank's risk is basically zero. They own the house. You're just living in it and paying them for the privilege. And you're paying them a lot. Auto loans. An auto loan is what you get when you want to buy a car. And here's where things get interesting because cars are depreciating assets. That means the moment you drive that car off the lot, it loses value. A lot of value. You buy a $30,000 car, drive it home, and boom, it's worth $27,000. You just lost $3,000 in value in like an hour. But you still owe the bank $30,000, so now you're underwater. You owe more money than the car is worth. This is called being upside down on a loan, and it's not a great place to be. Most auto loans are for 5 to 7 years, so you're paying for a car that's depreciating while you're paying for it. By the time you own it outright, it's worth maybe half of what you paid for it. But you've paid the full price plus interest. It's like buying something at full price and then watching it lose value while you're still paying for it. You're essentially paying interest on an asset that's losing value every single day. It's like paying someone to watch your money disappear. But people do it anyway because they need a car to get to work. So the bank wins again, and the car company wins. Everybody wins except you. Personal loan. A personal loan is the bank's way of saying, we don't know what you're going to do with this money and we don't really care. But we're going to charge you a lot of interest just in case. Personal loans are unsecured, which means the bank doesn't get to own anything if you don't pay them back. They can't repossess your house or your car, so they charge you way more interest to make up for that risk. You might see interest rates on personal loans anywhere from 6% to 36% depending on your credit score. That's insane. If you have bad credit and you take out a personal loan for $10,000 at 36% interest over 5 years, you're paying back almost $20,000. You're paying double just because the bank thinks you might not pay them back. And here's the kicker. Personal loans are often used for things that don't increase in value. You might take out a personal loan to pay off credit card debt or to take a vacation or to buy furniture. None of those things increase in value, so you're paying interest on something that's making you poorer, not richer. It's the opposite of an investment. It's a wealth destroyer. You're literally paying money to become poorer. But people do it anyway because they need money now and they're willing to pay for it later. The bank knows this. They're betting on your desperation. Student loans. Student loans are special because they're the one type of loan that society has collectively decided is a good idea, even though it might be the worst idea. Here's how it works. You want to go to college. College costs a lot of money. Like a lot. We're talking $20,000 to $100,000 depending on where you go. So you take out a student loan. The government or a private bank gives you money to pay for school. You go to school. You graduate. And now you owe money. Lots of money. The average student loan debt is around $37,000 per person. That's a car. That's a down payment on a house. That's a lot of money to owe before you even have your first real job. Here's what makes student loans different. They're designed to be paid back over a long time, like 10 to 25 years long. So you're paying interest for a quarter of your life. And the interest rates are usually lower than personal loans, which is good. But here's the problem. You're taking on this debt before you even have a job. You're betting on your future earning potential. You're saying, I'm going to go into debt now because I think I'll make enough money later to pay it back. And sometimes that bet pays off. Sometimes it doesn't. If you graduate and you can't find a job in your field, or you find a job that doesn't pay very well, you're stuck paying back a loan for an education that didn't help you make more money. That's a trap. That's a real trap. and millions of people are in it. Business loans. A business loan is what you get when you want to start a company or expand an existing one. And here's where things get really interesting because business loans are basically the bank betting on your ability to make money. If you want to open a restaurant, you need money for equipment, inventory, rent, and payroll before you've made a single dollar. So you go to the bank and you say, I have this idea, can you give me money? And the bank says, okay, but we're going to need to see a business plan. We're going to need to see your personal credit score, and we're going to need collateral. Collateral is basically insurance for the bank. It's something you own that the bank can take if you don't pay them back. Most business loans require you to put up collateral. Maybe it's your house. Maybe it's your car. Maybe it's the equipment you're buying with the loan. The bank is essentially saying, we don't trust your business idea, so we're going to make sure we can get our money back no matter what. Business loans have higher interest rates than mortgages or auto loans because they're riskier. A mortgage is backed by a house that probably won't lose value. An auto loan is backed by a car, but a business loan is backed by your ability to run a successful business. And statistically, most new businesses fail, so the bank charges you more interest to make up for that risk. The average small business loan has an interest rate between 2.5 and 13% depending on the lender and your credit, and the terms are usually shorter than mortgages. You might have 5 to 10 years to pay it back instead of 30, so your monthly payments are higher. And if your business doesn't make money, you still have to pay the bank. You don't get to declare bankruptcy and walk away. The bank will come after your collateral. They'll take your house. They'll take your car. They'll take whatever you promised them. So a business loan is a bet. You're betting that your business will make enough money to pay back the loan plus interest, and the bank is betting that you'll fail and they'll get to take your stuff. Lines of credit, LOC. A line of credit is basically a credit card's more sophisticated cousin. Here's how it works. The bank says, we're going to give you access to a certain amount of money. You can borrow as much or as little as you want up to that limit, and you only pay interest on what you actually borrow. So if the bank gives you a line of credit for $50,000, you don't have to borrow all $50,000 right away. You can borrow $10,000 this month and $5,000 next month, and you only pay interest on the $15,000 you've borrowed. This sounds great, right? And in some ways, it is. A line of credit is more flexible than a traditional loan. You're not locked into borrowing a specific amount. You can borrow what you need when you need it. But here's the catch. Lines of credit usually have variable interest rates. That means the interest rate can change. If interest rates go up, your interest rate goes up. So you might start with a 5% interest rate, but a year later it could be 8%. Your monthly payment just went up and you didn't borrow any more money. The bank just decided to charge you more. There are two types of lines of credit: secured and unsecured. A secured line of credit is backed by collateral. A home equity line of credit, or HELOC, is a secured line of credit backed by your house. An unsecured line of credit is not backed by anything. The bank is just trusting that you'll pay them back. So unsecured lines of credit have higher interest rates. You might see interest rates anywhere from 7% to 21% on an unsecured line of credit depending on your credit score. So before you sign that dotted line, before you commit to years of payments, ask yourself this: is this loan worth it? Is this thing I'm buying worth paying double for? Because that's what you're doing. You're paying double. The bank is making sure of it, and now you know exactly how they're doing it. Understanding these 6 types of loans is the first step to making smarter financial decisions. The second step is asking yourself if you really need to borrow at all.